Well, guys, now that the One Big Beautiful bill has passed, you can expect the borrowing and spending floodgates to open. And part of that is because the Treasury general account will need to be refilled from its current levels of around 350 billion all the way up to where it wants it to be around 850 billion. This will drain bank reserves, it will decrease liquidity in the financial system, and it will probably force the Fed into measures to increase liquidity, like ending QT, maybe even restarting QE, pushing interest rates down, and more. And all of those have major implications for you and the markets. And no, I have not been cloned and replaced by an evil twin. I have a mustache now. I'm traveling, which also explains the temporary recording setup, and I did not adequately account for the differences in power outlets here. My beard trimmer blew up on me in my hand. My only option was to shave the entire beard off, but I kept the mustache. Let me know in the comments section below whether I should keep the stash or not. Okay, back to the Treasury General Account. First of all, what is this thing? This is essentially the government's bank account. It is their checking account. If you expand the timeline here, you can see this account was not really used until after the financial crisis. And the reason for that was prior to the financial crisis, the government kept its money inside the banking system. But because of the start of debt monetization, which we call quantitative easing, there's going to be a lot more cash held inside the Treasury General Account or inside the government's checking accounts. The Fed didn't want that impacting things like banks' leverage ratios, collateral assets, and all that. And so they put this Treasury General Account off to the side outside of the banking system. And now it's just an account held at the Federal Reserve. So it doesn't impact the banking system whatsoever. Now, over the last 10 years, we've seen some wild fluctuations. It used to hover around the 200 to 400 billion mark. And then after all the money printing that happened in 2020, we saw the Treasury General Account spike up to about 1.8 trillion before it drained all the way back down to only about 84 billion. And it's been volatile since then, but the Treasury does like to keep it around the 700 to 800 billion dollar mark now. Now, you will likely hear a lot of misinformation about the Treasury General Account, primarily from people who do not understand what it is. When they see the number in the Treasury General Account going up and down, they usually say this is quantitative tightening or this is quantitative easing. It is nothing of the sort. In fact, in general, on net, over the long term, whatever happens in this account is actually 100% meaningless, because the only way cash can get into the Treasury General Account is through either taxing or borrowing. And those dollars have to come from somewhere. And so if the Treasury's checking account is increasing in size, that means somebody else's checking account is decreasing in size. This is not the Federal Reserve. There is no printing that is happening here. Similarly, when the Treasury General Account goes down, a lot of people say it is QE or it is stimulative, and that's because a bunch of cash is leaving the government's accounts and going into somebody else's checking accounts. But we have to remember how it got into the Treasury General Account in the first place, which was from taxes or borrowing. And so the only way that money comes in and out is by money going in and out. There's no actual printing going on specifically with the filling or the draining of the Treasury General Account. So this specifically by itself is not QT, is not QE. It's just money coming in from somewhere, money going out to somewhere. On net, there is no creation or destruction of dollars in the system. That being said, in the short term, it absolutely can have an effect on liquidity in the financial system. Because if you imagine, when this thing starts to fill up really fast, like I said earlier, those dollars are coming from somewhere. And because tax revenue is very predictable, they're not just turning it on and off at will. The way that they refill this account is through extra borrowing. All that borrowing has to take cash and liquidity from somewhere. Now, if you take a look at this Treasury presentation from treasury.gov, which is the fiscal year 2025 quarter 2 report, we just have to go down to the executive summary on page 4, and we find right here the projected end of quarter cash balances are at 850 billion. The only reason they are not there at this point is because the Treasury has had to use the funds that were in there to draw down on them until the debt ceiling was raised. Now, I mentioned at the beginning of the video that the One Big Beautiful bill has now passed, which means that that debt ceiling has been raised. So the Treasury no longer has to rely on drawing down the cash it has already borrowed and taxed in order to fund expenses. It can now borrow again and refill that checking account back up. Now, in theory, the Treasury could issue whatever debt they wanted for any duration. They could issue 30-year bonds. They could issue 1 or 2 month T-bills. The problem is, liquidity is already fairly strained in the financial system right now. And Trump has basically said he doesn't want the Treasury to issue anything but the shortest term debt possible right now because interest rates are still high. In a recent interview, Trump stated that he was going to refinance the $9 trillion that is maturing over the next year as short-term debt only because we have a stupid person at the Federal Reserve. He does not want to roll over that debt that is maturing into longer-term debt like 2, 10, 20, or 30-year treasuries because then he's locking in that higher interest debt. Remember, within the next 9 to 12 months, there's about $9 trillion worth of debt that is maturing, which means the government has to pay it back. They don't tax enough to pay their expenses, let alone to pay off $9 trillion worth of debt. The only way they can pay that back is by borrowing new debt. And they get to choose whether they want to borrow 1-year debt, 6-month debt, or 30-year debt. And with 20-year yields right under 5%, Trump does not want to lock in 5% interest rates for the next 20 years and would much rather roll it over at 4.3%, even though that's going to continually be maturing and it'll have to continue rolling it over and it will continue to suck liquidity out of the system. And he has said he's just going to continue doing that until interest rates go down far enough where he feels comfortable refinancing it and rolling it over into longer term debt to lock in lower rates for the long term. Now, so far, the Federal Reserve has resisted this political pressure to lower rates for Trump, but that will not last long. We are about to see interest rates drop over the next year, potentially by a lot. We're also about to see things like quantitative tightening stop and maybe even quantitative easing restart. But more on that in just a moment. You might be wondering why short-term debt, like 6-month T-bills, only has a yield of like 4.3% right now when so much of the debt is getting rolled over there. You'd think that all that T-bill issuance would be so much supply of T-bills that it wouldn't be able to be soaked up by the market. In other words, not enough demand for it, which would drive prices down and the interest rates higher. But in reality, there's like almost an insatiable demand for T-bills because there's basically no risk there. Aside from lending your money to the Federal Reserve, who can print money to pay you back plus interest, T-bills are the next lowest risk option. You don't have risk of default now that the debt ceiling has been raised. And let's be honest, even before that, the risk of default was basically zero anyway. You don't have interest rate risk because it's such a short duration that even if interest rates move in that amount of time, you're not locked up for that long. And also, you don't really have any inflation risk with T-bills because it's not like you're locking your money up for 10, 20, 30 years, and you don't know how much the dollar will be devalued during that amount of time. And so from financial institutions to corporations, there's almost an unlimited demand for T-bills as they give you a way to protect your money slightly from inflation, have almost all the liquidity that you need, and pretty much zero risk. But despite all of that, on Monday, June 30th, the Federal Reserve had to intervene in the repo market again for the first time since 2019. Last week, I made an entire video on this topic, but basically it means reserves are almost gone in the financial system. Liquidity has been sucked dry. And this onslaught of borrowing, number one, just to refill the Treasury general account back up to about $850 billion, represents $500 billion of T-bill issuance that's going to happen within the coming weeks and months. Not to mention the fact that all of the other spending that is being planned now and that is being unleashed is also going to have to get borrowed for. This is exactly what happened in September of 2019, when the Federal Reserve was still trying to taper its balance sheet, engaged in quantitative tightening, but the government had borrowed and spent so much that financial markets were tapped out. Liquidity was gone. The repo market almost blew up. They had to intervene and restart QE. Remember, at the time, they called this not QE. The Fed had to start injecting money to bail out the repo market, just like they did a few weeks ago, and quantitative easing resumed again. We're in that exact same position now with the Fed continuing to try to decrease its balance sheet. That's going to end. We're likely to see a restart of QE, and it probably won't be enough. We'll probably also see lowering of interest rates as well. If you thought the rally in the stock market over the last couple of months, being up 30% since April, was a lot, keep in mind, we are barely back over previous all-time highs, just retracing the prior crash. And all of this without lowering interest rates, without restarting QE, and now the government is about to drain the last reserves out of the system, forcing liquidity injections. If you are not prepared for both the melt-ups in assets asset classes, and also the volatility and flash crashes that will happen along the way, then you need to get my hedged hyper growth portfolio blueprint. I've designed it for markets exactly like this. I'll give you a step-by-step plan on what to do here so you maximize your profit and taking advantage of all the liquidity that's coming into the market right now, but you also are not exposed to downside risk. It's linked for you in the description below. As always, thank you so much for watching. Have a great day.